Stock Bro coming to you again, back to back with videos, because I'm just basically trying to, put in video form any lessons learned with what's going on. So the other thing I wanted to bring up GameStop again. So GameStop, this short squeeze is insane. Yesterday, Elon Musk has a big following. When he tweeted GameStonk, and then he also forwarded that whole, that whole thread from Reddit from, what's it called? Wall Street Bets, that caused GameStop to move, I think, 50-60% in after hours trading. Now, people that have large short positions, there's not enough liquidity in after hours trading, meaning after 4 p.m., after the market closes. There's not enough liquidity for them to do much trading there. So now you have to think they're going to have to now wake up in the morning and they're going to be down another shitload of money. So they're going to have to start chasing that again. They're going to have to start getting out of their shorts. There are prime brokers that will call them and say, we cannot fund this position for you anymore. It's too risky. You need to buy back your short. You're losing way too much money. And we don't know, you might go under. So buy this thing back before things get worse. That's the sort of thing that happens that a lot of day traders aren't aware of. I'm aware of it because I traded for, 16 years or whatever it was. So that said, that's gonna then drive it up even more, because people are waking up, and it's like, imagine you being told by your E-Trade or Ameritrade or your prime broker, depending on what type of investor you are, and it's like, you have to buy these shares back. You cannot maintain the short position. So you're chasing it up, and then other people that might have had more liquidity than you, they're now losing money as you're chasing it up. Then they're getting phone calls because now they've lost too much money, and so now they've got to buy back. And this is what's going on with it. I'm sure of that. And if I'm wrong about that, then then I'm wrong about that. The other thing I want to say is, when it comes to options, this is a good lesson in the options. Options give you the right to either buy or sell, depending on call or put, a stock at a future date. You agree to buy it. And basically what an option is, you basically have the market that, if you'll say you're looking at January 2023, you're saying, okay, I think that the stock is going to trade maybe here at that point. The market thinks it's going to trade there. If you think that you, for whatever reason, if you like the risk and you think, the market's got it wrong, I think it's going to be a lot higher than that, you'll buy a call. If you think the market's got it wrong, it's going to be a lot lower than that, you'll buy a put. Now, in the case I bought, this is interesting. I bought some GameStop puts this morning. And the thing is, what's interesting is that because calls and puts are driven by the implied volatility of that stock, meaning the price of a call and put, it's going to be more expensive to buy an option on a stock if it's likely to move a lot in a short period of time. Some stocks that are really stagnant and don't do much, that are just kind of like, and don't really have, they're just maybe such big companies, something like Nestle, where it's not going to move, the needle's not going to move very much. It's pretty much almost going to just move with like inflation and that sort of thing. Those are going to be really cheap options. But when you have a stock like GameStop that's moved on some days over 100%, it's going to be very expensive to buy an option on that. And that's what happened today. And what was interesting was the implied volatility went up so much that even if you had a put option, which you only make money if the stock comes lower, that because the implied volatility was increasing, that the stock price went higher and my puts were actually worth more. It's counterintuitive, but if you think about it, it makes sense, because, even though the stock's gone higher and you think, well, I've agreed to sell it here, now it's up here, like I should be losing more money, but it's like, no, the stock has gone up so much today that that implied volatility is being worked into the cost of the put. And the fact that it's gone up so much today means that even though it's gone up this high, it's very likely that it could be down a lot in the coming future. And so you can actually make money on the volatility, even though your brain is telling you, why am I making money on a put when the stock's going higher? Or why am I making money on a call when the stock's tanking? And I'm only supposedly, going to make money on this in theory if it goes higher. So it's more about the implied volatility. I hope I explained that well. It's a little tricky, but I'm just letting you know if any of you are invested in options and you didn't really understand what was going on and why maybe you're like, wait, it's just popped another $50 and I'm making money and I've got to put. And because I want this stock to drop all the way down to 20, which is where it probably is, fair valued. That's what happened. That's all I got from the Bro Pit. This is Stock Bro, the real day trader of Beverly Hills, signing out. Goodbye and good luck.